numbers, estimating the revenues, and knowing what the income margin is, and then using that to calculate the earnings. But then the trickier part is getting this PE. And the PE really is, did I talk about the PE last time?
Yes, in the first.
Yeah. The PE really is a function of the risk and of the growth prospects. So what you try to do is, I'm going to skip over to what you try to do is compare the PE of your company to other companies that are like it. And really, did I show you this chart last time? Yeah, okay. The S&P 500 is sort of an average of the price of 500 stocks. And they also calculate the earnings of the 500 companies that are in the S&P. So you can think of the S&P 500 as a company. And as such, historically, you can calculate what the price is and what the earnings are, and you can calculate the PE. And you can see that the PE goes all over the place, okay? Now, I could show you a longer chart of this, and what you'll see is that the PE will closely follow, first of all, interest rates. The lower the interest rates, the higher the PE of the S&P 500. Because if you go back and you remember your dividend discount formula, it says that the price is a function of D0, 1 plus G, R minus G. So R, the interest rate, shows up, the discount rate shows up on the bottom. So the higher that, the bigger that number is, the smaller the price is going to be. So that's why PE goes that way. It also, you can see at different points in time where you have crises, the PEs start to go flopping around. Now you get these curious things like this. This is 2008, when everybody suddenly, the economy crashed and people's earnings just crashed. And so it looks like here you have a very high PE, but it's not because the companies are doing well and their P is high. It's because everybody's doing so poorly and the E is so low. So you've got to sort of look at these graphs a little bit carefully. But if you look over long periods of time, the PE on the S&P 500 is somewhere between 18 and 20, okay, on average, over long periods of time. Sometimes it's higher, sometimes it's lower. Right now, today, it's about 17. Last year, it was lower than that. But on average, it's about 18 to 20. So this is sort of where you start. And then the next thing you've got to focus in on is, and that's why I asked you to calculate what the average was for these financial ratios for Lowe's and for Kohl's and for I asked you to calculate the average of those two companies, and I said we can think of that as an industry. And what you find out when you do that is that and I'm sorry I don't have that on this particular thing, I took it off. When you do that, you find out that for retail companies, like Kohl's and so forth, the PE of that industry that they're in is roughly the same as the PE of the S&P 500. It's actually generally just a little bit less, okay? So if the PE of the market is 18, the PE of those retail stores on average is probably going to be about 17. Okay, just a little bit less because they don't grow as quickly. And then the third thing you have to do is you've got to look at the two companies relative to the average and say which one is better and which one is worse. Because, let me see if I've got another file here that might show this better.
Yeah, that's what I'm going but things are going out a whole lot. Got a lot less work. Yeah. It's amazing. Really? Yeah. Oh, yeah. Oh, but that's sort of nice.
Okay. What I did here is I created an industry. I asked you last time, I said at some point you've got to get these financial ratios for these two companies, for Kohl and for Target. And I said these are the financial ratios that you probably want to look at, because these are the financial ratios that are going to be important for assessing the PE. And I said if you calculate it, this is Lowe's and Home Depot, but I asked you to do it for Kohl and for Target. I said if you do it for those two companies, you can think of those two companies, for starters, as the industry, as that segment of the retail industry. And simply by taking the average of the financials for those two companies, you can get what the industry benchmark is. When you compare something to like an industry, you're saying you're comparing it to a benchmark. You can get what the benchmark is for that industry. So for example, in this sector, which is the home improvement sector, the typical company, if I look here, might have a total debt ratio of somewhere around 45 to 50%. Okay? If you look at the gross profit margin, a typical company might have a gross profit margin of about 34%. That's what you're interested in. Okay? And you're interested on how these numbers, you might be interested on how these numbers change over time, but you want to get a sense of what the industry benchmark is that you're comparing things to. So then if you look at a particular company, if you were to look at Lowe's, for example, you'll see its gross profit margin is higher than the average. All I did was compare its margin to the industry average, whereas here, for Home Depot, it's worse than average, okay? And the reason this knowledge is important is because all this gives you information on, first you have the market's PE, then you know whether the industry generally has a higher or lower PE than the market. So for example, where do you think the PEs of the technology companies are relative to the market? Go back and think about what determines the value of a company. It's really the higher the growth rate, the greater the value, the higher the risk, the lower the value. But then the other thing that's true is that growth tends to trump risk. Okay? In most environments, growth tends to trump risk. So if you look at the technology industry, do you think it would have a high value or a low value assigned to it? Why?
Because it grows.
Because it grows very, very quickly. They're risky, but they grow very, very quickly. If you were to look at something like a utility, would it have a high or a low? Low. It's very, very safe because, you know, no matter what happens, we all need water and we all need power. But it only grows as quickly as the area that it's servicing grows. So that's, you know, why the industries have different PEs, okay? They range from, if the average is 18, technology might be 24, and energy and utilities might be somewhere around 12, 13, 14, okay? So they range like that. But then if you look at a particular company within an industry, you have to ask, is that company better than the average company or worse than the average company? And that's where this kind of stuff starts to come in, particularly the leverage ratios, because if a company has more debt than average, it's riskier. Because remember, when you buy a stock, what you have claim to is the profits after all the debt holders have gotten their share. So if a company's got a lot of debt and something happens to that company's revenues, it's still got to pay the debt holders. So what's left over for you goes down, okay? Whereas if it has very little debt, yeah, that money's got to go, but you still keep the majority of the profits, okay? So everybody's profits are going to go down, but a company with a lot of debt, you as a shareholder are going to get much less, okay? Similarly, numbers like this, the coverage ratio, tells you even if the company has a lot of debt, does it have a lot of money to pay off what it has to in the way of interest? If it's got debt but it's got a good coverage ratio, that can offset it, okay? Then the final thing that you want to look at here, oops, it's always difficult to see with this light, are these profitability ratios. Because if you see one company produces less profits than the other, you'd like the one that produces more profits. Or if you see that a company's profitability is going down over time, you've got to ask what's going on there, okay? So these things, the reason you look at this is you want to get a sense of what kind of PE to put on it. And it's not just a willy-nilly PE. You start out with, what's the market PE? The market PE is 18. How does this industry compare to the market? If it's got high growth prospects relative to the market, to the average company, it will have a higher PE. If it's got less than average growth prospects, it'll have a lower PE. So then you look at the industry. And then finally, you look at the company. And you say, relative to the industry, is it going to be higher or lower? So that's how you start layering on these different decisions.